Hey everyone, and welcome to The Explainer. Today we're tackling a big one. We're talking about an investment tool that's built for one single, really ambitious reason: to beat the market. Let's get right into it. It's a question I think every investor asks themselves at some point. Are my investments just supposed to follow along, or can they actually try to beat the stock market, right? I mean, we always hear about just matching the S&P 500, but what if there was a tool out there designed to aim higher?
Well, that's where this special kind of investment comes into play, the active ETF. Think of it as this really interesting blend of stock-like flexibility with a super hands-on strategic approach. So what the heck is an active ETF?
All right, let's break it down. To really get what these things are, you got to understand how they're different from the ETFs you probably hear about all the time, the passive ones. Okay, so the key word here is active. Unlike your standard index ETF that just automatically buys whatever's in, say, the S&P 500, an active ETF has a real person or even a whole team of pros behind the wheel. They are literally making choices, picking and choosing stocks, trying to find the winners, all for one reason: to outperform the market benchmark. And this chart, man, it lays it out perfectly. Look, on one side, you've got active management. The goal is to outperform, to beat the index. The method, a manager is actively picking stocks. On the other side, you've got passive tracking. The goal there is just to match the index. The method, just automatically follow the rules. It's kind of like, are you trying to win the race, or are you just happy to finish with everyone else? And there's actually a cool finance term for this outperformance. It's called alpha. So whenever you hear investment folks talking about generating alpha, this is exactly what they mean. It's all about getting returns that are above and beyond what the general market is doing. That's the whole ballgame for an active manager. Okay, so their mission is to find that alpha. But what else makes these ETFs tick? What are the key characteristics that set them apart? Let's dig in. So you've got a few big things here. First, that active management we talked about. This gives them incredible flexibility. A manager can see a storm coming and maybe sell off some stocks to protect your investment, or they can jump on a hot opportunity they find. They're not stuck on autopilot. Then there's transparency. This is huge. Most of them have to show you what they own every single day. And finally, they still have that great tax efficiency that all ETFs are known for. And you knew there was a but, right? There's no such thing as a free lunch. Having a team of experts doing all this work, the research, the analysis, the buying and selling, it's not free. That potential for a bigger reward comes with a higher price tag. And that price tag is called the expense ratio. It's the annual fee you pay. So you might be asking, why would I pay more? Well, you're essentially making a bet. You're betting that the manager is so good that their picks will make you enough money to not only cover that higher fee, but to still come out ahead, to deliver that alpha. You're paying for their brain power. Okay, let's say this sounds interesting. You've thought about the costs, and you think the shot at getting some alpha is worth it. So, how do you actually do it? How do you buy one? Let's get practical. For all of our Canadian viewers, it's actually pretty simple. You just hop on a platform like Wealthsimple or Questrade, open an account if you don't have one, and put some money in it. Then you just search for the ETF you want, usually by its ticker symbol, and hit buy. And for our friends in the US, it's pretty much the exact same story. You'd use a broker, like a Charles Schwab or an Ally Invest. You open an account, fund it, find the ETF's ticker, and place your order. Super straightforward. All right, hang on. Before you go clicking that buy button, we need to talk about a few really important things to consider first. Seriously, being smart about what you're buying is just as important as the act of buying it. Think of this as your pre-flight checklist. First, residency and taxes. You got to know the rules where you live. Second, those expense ratios. Compare them. A tiny difference now can mean thousands of dollars over the long run. Third, look at the holdings. Pop the hood and see what stocks are actually in the fund. Does it match what you're trying to do? And for my fellow Canadians, if you're buying a US ETF, watch out for those currency fees. So what's the bottom line here? It's this. Active ETFs offer you the potential to beat the market. And that word potential is everything. It's not a promise. It's not a guarantee. And you're paying a premium for that chance. It's the classic risk versus reward trade-off, plain and simple. And that really leaves us with the final, most important question. And it's one only you can answer for yourself. We've talked about the how these things work, how to buy them. But does it fit your why? Is the chance of beating the market worth the extra cost and the risk for your own financial journey? That's the real question to mull over. Thanks for tuning in.